All right, Andrew John here, and I need you to lock in for the next few minutes. What I'm about to share with you is not speculation, it's not theory, and it's not another doom and gloom clickbait narrative. This is about a critical market dislocation happening right now, in real time, that most investors won't understand until it's far too late to protect themselves. Credit spreads have just blown out to 12 basis points in the United States, and in London we're seeing spreads hit 18. Now, if those numbers don't immediately alarm you, let me be crystal clear about what this means. Lenders are stuck. The credit mechanism that underpins our entire financial system, the lifeblood of corporate borrowing, consumer lending, and economic expansion, is seizing up. This is not a drill. This is the kind of market signal that precedes major dislocations, the kind that separates those who preserve wealth from those who watch it evaporate. Over the next 25 minutes, I'm going to walk you through exactly what credit spreads are, why this blowout matters more than almost anything you'll hear in the mainstream financial media, and most importantly, what you need to do right now to position yourself on the right side of this trade. I'm going to show you the historical parallels, the mechanical breakdown of why this is happening, and the three asymmetric plays that could not only protect your portfolio, but potentially multiply your wealth during the chaos ahead. This is not about fear. This is about preparation, pattern recognition, and profit. So turn off the distractions, grab a notepad, and let's break this down step by step. Before we dive into the current crisis, you need to understand the foundational framework that governs every major market dislocation in history. I call this the asymmetric dislocation framework, and it's built on a simple premise that most investors completely ignore. Markets don't move in straight lines, and wealth isn't created by following the herd. Real generational wealth is built by recognizing structural imbalances before they break, positioning yourself in undervalued, unloved assets, and then waiting for the inevitable reversion. The key metric in this framework is something called the credit spread. And if you don't understand what this is, you're flying blind in today's market environment. A credit spread is the difference between what a risky borrower pays in interest versus what a safe borrower pays. Think of it this way. The US Treasury is considered the safest borrower on the planet. When they issue bonds, they pay a certain interest rate, let's call it the risk-free rate. Now, when a corporation wants to borrow money, they have to pay more than that risk-free rate because there's a chance they might default. That extra interest they pay, that premium, is the credit spread. When credit spreads are tight, meaning the difference is small, it signals that lenders are confident, that they believe borrowers will pay them back, and that risk is low. But when credit spreads blow out, when that difference widens dramatically, it means lenders are terrified. They're demanding much higher compensation for the risk of default because they see trouble ahead. And right now, spreads are blowing out to levels we haven't seen since the early warning stages of previous financial crises. This is the canary in the coal mine, and it's not just chirping, it's dying. The core thesis of this video is simple but profound. We are witnessing the early stages of a credit market seizure driven by unsustainable debt levels, rising real interest rates, and a global economy that cannot afford the cost of money at current levels. This dislocation will create three distinct asymmetric opportunities in deep value assets, inflation-leveraged real assets, and systemic hedges like precious metals. If you understand this framework, you can position yourself to not just survive, but thrive in the environment ahead. Now let's turn to history, because if you don't learn from the past, you're doomed to repeat its most expensive lessons. The pattern we're seeing today, credit market stress leading to systemic breakdown, has played out twice in the last century with devastating consequences for those unprepared and life-changing wealth creation for those who saw it coming. The first parallel is the Great Depression, and specifically the credit crunch of 1930 to 1933. Most people think the stock market crash of 1929 was the main event, but that's a fundamental misunderstanding of what actually destroyed wealth. The real devastation came in the years after the crash when the credit markets froze. Banks stopped lending, corporate borrowing dried up, credit spreads exploded, as lenders realized that the debt bubble of the 1920s was built on a foundation of sand. Between 1930 and 1933, over 9,000 banks failed in the United States. 9,000. These weren't small regional institutions. These were the pillars of the financial system, and they collapsed because the borrowers couldn't pay, the collateral was worthless, and the credit mechanism seized. What's critical to understand is that the investors who preserved and grew their wealth during this period were the ones who recognized the credit warning signs early. They moved out of overvalued equities and corporate bonds and into hard assets, particularly gold, which was revalued from $20.67 per ounce to $35 per ounce in 1934. A 69% gain while the rest of the economy was in ruins. They also bought deeply distressed real assets, farmland, industrial equipment, and even entire businesses at pennies on the dollar. The lesson here is not to predict the exact timing of the collapse, but to recognize the structural imbalance and position accordingly. Credit spreads blowing out in 1930 were the final warning before the full systemic breakdown. Those who heeded that warning and repositioned their portfolios were the ones who emerged wealthier on the other side. The second historical parallel is the stagflation crisis of the 1970s, and this one is even more relevant to our current situation. In the early 1970s, the United States was drowning in debt from the Vietnam War and Lyndon Johnson's Great Society programs. The Bretton Woods system, which pegged the dollar to gold, was collapsing because foreign governments knew the U.S. had printed far more dollars than it had gold to back them. In 1971, Nixon closed the gold window, and the dollar became a pure fiat currency. What followed was a decade of chaos. Inflation soared into double digits, interest rates skyrocketed, the economy stagnated, and credit spreads, you guessed it, blew out. Lenders demanded massive premiums to compensate for inflation risk and default risk. Corporate borrowing became prohibitively expensive. The credit mechanism didn't freeze entirely like it did in the 1930s, but it became severely dysfunctional. And here's the key insight. During this period, traditional 60-40 stock and bond portfolios were destroyed. Stocks went nowhere for a decade when adjusted for inflation. Bonds got crushed as interest rates rose. But gold, silver, and other hard assets exploded. Gold went from $35 per ounce in 1971 to over $800 per ounce by 1980, a 2,200% gain. Silver went from $1.50 to nearly $50. Energy stocks, commodity producers, and real assets massively outperformed. The investors who recognized that the credit market stress of the early 1970s was a signal of deeper systemic rot, and who repositioned into inflation hedges and real assets, didn't just survive the decade. They became wealthy beyond their wildest dreams. The lesson from the 1970s is that when credit markets signal distress in an environment of high debt and monetary debasement, the asymmetric play is to move away from financial assets and into tangible, inflation-resistant stores of value. And that brings us to today. We have higher debt levels than the 1930s. We have more aggressive monetary expansion than the 1970s, and now credit spreads are blowing out just like they did before both of those historic dislocations. If you understand these patterns, the path forward becomes clear. So let's talk about what's happening right now in the credit markets and why this is such a critical juncture. As of this week, credit spreads in the United States have widened to 12 basis points, and in London, they've hit 18. To put that in perspective, during periods of economic calm and market confidence, credit spreads typically sit in the 3 to 5 basis point range. When they start pushing into double digits, it's a red flag. When they hit the mid-teens, it's a full-blown alarm. What this tells us is that lenders, the banks, the bond investors, the institutional capital allocators are pulling back. They're demanding higher compensation for risk, and in many cases, they're simply refusing to lend at all. This is what I call credit market constipation. The flow of capital is slowing, and if it continues, it will stop entirely. Now, why is this happening? There are 3 interconnected drivers, and you need to understand all of them to see the full picture. First, global debt has reached absolutely unprecedented levels. According to the Institute of International Finance, global debt hit $315 trillion in 2025, which is over 330% of global GDP. This includes government debt, corporate debt, and household debt. To put it simply, the world has borrowed more money than it can ever realistically pay back at current interest rates. For decades, this wasn't a problem because interest rates were at or near zero. Governments and corporations could roll over their debt cheaply. But now, with central banks having raised rates aggressively to fight inflation, the cost of servicing that debt has exploded. Corporations that borrowed heavily during the zero-rate era are now facing refinancing at 5%, 6%, 7%, or higher. Many of them simply can't afford it, and lenders know this. They're looking at the maturity walls, the mountains of debt coming due in 2026 and 2027, and they're realizing that a significant portion of borrowers are going to default. That's why credit spreads are blowing out. Lenders are pricing in a wave of defaults that hasn't fully materialized yet, but is absolutely inevitable. The second driver is the return of real interest rates. For over a decade, real interest rates, meaning the nominal interest rate minus the inflation rate, were negative. You could borrow money at 2% when inflation was 3%, meaning you were effectively being paid to borrow. This created a massive incentive to lever up, to borrow as much as possible and invest it in anything with a yield. But now real rates have turned positive. The Federal Reserve's policy rate is above the inflation rate, and that fundamentally changes the calculus. Positive real rates mean that debt is now a burden, not a tool. It has to be serviced out of real economic productivity, and in an environment of slowing growth, that's nearly impossible for many borrowers. This is why we're seeing stress in commercial real estate, in leveraged buyouts, in zombie corporations that only survived because of cheap money. The moment real rates turned positive, their business models became unsustainable. And lenders, once again, see this. They're pulling back, demanding higher spreads, and in many cases, refusing to extend new credit. The third driver, and this is the one most people completely miss, is what I call the quiet mechanism of financial repression. Governments around the world are trapped. They have massive debt burdens, aging populations, and massive fiscal commitments they cannot meet without either defaulting, inflating the debt away, or engaging in financial repression. Financial repression is a policy framework where governments deliberately keep interest rates below the rate of inflation, forcing savers and creditors to accept negative real returns, while the government inflates away the real value of its debt. We saw this after World War II, and we're seeing it again now. But here's the problem. Financial repression requires cooperation from the credit markets. It requires lenders to keep lending at artificially low rates. And when lenders start to rebel, when they start demanding higher spreads to compensate for the hidden inflation tax, the whole mechanism breaks down. That's what's happening now. Lenders are saying, we're not going to accept negative real returns anymore. We're not going to keep funding governments and corporations that are insolvent. We want higher compensation, or we're not playing. And that rebellion is showing up in the credit spreads. So what are the three asymmetric plays in this environment? Let me be very clear about this. The first play is deep value in distressed credit and unloved sectors. When credit spreads blow out, it creates opportunities to buy high-quality assets at distressed prices. I'm talking about investment-grade corporate bonds trading at discounts, senior secured loans with strong